Hey everyone, thanks for joining me here, Greg at Money Vikings. And I've got a very interesting and important one for you today. I want to talk about a secret of investing that is not commonly taught. And it gets to the heart of why we started Money Vikings as a blog. And now we, of course, have our YouTube content. Financial education in general just really stinks. I'll use clean language for the video. It's just really not that good. And one of the biggest things that people miss, they tend to think, and, Wall Street and all kinds of players play into this because they make a lot of money off of us. They tend to think that you need to be some really, high skilled, technical stock picker in order to be successful at investing. And now, after doing it for a couple of decades, I think that's absolutely not true. And in fact, the opposite is true. I think portfolio construction and asset allocation is, in fact, critical and absolutely more important to understand than any individual stock. So let's get into it, and I'm going to share our particular portfolio we call the ride your bike portfolio. The concept being that you set the portfolio and you can essentially just go enjoy your life. And that's what I think most people want to do. When you're building wealth, I don't think we really want to spend all day long looking at ticker symbols and blips on a screen. That's not life. That's not a life of true wealth in my personal book. And so I want to basically focus on overall portfolio construction and make adjustments as I see fit over time as things may change, but not major adjustments, to be honest. And then basically just fit that portfolio to my sort of particular risk tolerance. So that's what we're going to go into today. So first thing I'll say about that is Warren Buffett is famous for, essentially saying that most investors should just own the entire market through a VU, a Vanguard index fund, Fidelity, whatever it might be, but just an S&P 500 index fund. And there's a lot of beauty to this concept because, for one thing, an S&P 500 index fund, you're owning the breadth, the entire market. You're owning the top 500 companies that encompass the really entire market and many, many strong businesses. And the other thing that's beautiful about it is that it mitigates risk. And in addition to that, it is self-cleansing, they use the word, because what happens is companies become weaker and they don't fit the criteria and they fall out of the top 500. They're basically removed from the index. So you're just always owning the top 500, companies in various sectors. So I think there's a lot of beauty to this concept, and that's a key pillar of our overall portfolio construction. The second thing I'll talk about is I tend to trend towards a focus also on dividends. So Buffett's also famous for really enjoying the dividends that come in. Now, it's ironic because Berkshire does not pay a dividend, but many of the companies that he owns and invests in and are part of the Berkshire portfolio are dividend payers. So that's another area that I like to focus on, because what ends up happening when you are collecting a dividend off of investment, I find that there is a little less concern over the day-to-day, especially the day-to-day, or even the year-to-year ups and downs if it's a strong company. So as long as you're getting that dividend, you're getting something back from that initial investment. And so you're not at least I am, not quite as worried if the particular ticker or stock dips a little bit in the short run. Now, of course, over the long run, you'd like to see that company grow and you'd like to see your particular investment grow. But dividends are one way that you can initially get a payment. It's a passive income machine. And then the other thing to keep in mind is I'm a big fan in this portfolio of dividend reinvestment plans. So you're having those dividends buy more shares of that stock, and it kind of compounds. Well, it really does compound. So that's that. Another thing I want to talk about with Buffett is that, and dividend stocks is that, again, you don't have to sell the underlying stock in order to get some profit. You can get some profit initially from the dividend. Okay, so there you go. what I'm going to talk about is this. So, number one, you don't need to pick individual stocks. And that's the big sort of, I think, lie that, or maybe it's not a lie, but it's kind of an assumption, right? So, there's a lot of talking heads on cable news and they'll talk about this stock and that stock. That's all fine stuff, but I would just reserve that for later in an investor's journey to when they maybe want to play in individual stocks with maybe 5 or 10% of their overall portfolio. But I would create what we call a pyramid of strength, and I'll talk about the construction of that. It's roughly based off of, and you can do more research on this, but it's roughly based off of Ray Dalio's all-weather portfolio. And I just really love this concept because he builds a portfolio that, so most people, his argument is this: most people have a portfolio that does well during good times in the market, and then when the market's tanking or not doing well, it does really poorly. His portfolio adds a couple of elements in order to mitigate the risk, and that's kind of what we also tried to do with ours. And actually, so far, it's been pretty good, and it's held up strong in all kinds of different environments. So the first part of it for me personally is the 30% in what I talked about initially, an S&P 500 or other similar index fund, right? So 30% of my portfolio is invested in a low cost. So the critical key here as well is low cost. You don't want to be paying a 1% fee to someone for this very basic investment. That's going to really eat in to your returns and your money working for you over the long run. So it's got to be low cost. That's why places like Vanguard are so popular. Their expenses are so low. So you want a low cost index fund that's made up of the 500 large to medium high quality US companies. And 100 million people in the US own some shares of these companies. So that's a lot of people invested in these big companies. The Vanguard S&P 500 is a good example of this kind of exposure. And, it's just something that I think is a bedrock of a solid portfolio. And like for me, I go about 30%, maybe more at times if you're feeling more aggressive. Now, a supplement to that is I like something like a VIG or VDATX. And that's a dividend focused, it's like dividend appreciation fund. It focuses on companies that have strong and growing dividends. And so that's another way to kind of like diversify and maybe have a little bit different focus and then get some of that dividend as well. Okay, so that's 30%. Another 30%, I still like bonds. So bonds are different than equities, right? Equities are you own a stake in a certain company, you own a small slice of their future profits. A bond is different. With a bond, you are lending your money to a municipality or to a company to basically do something with that money. They're taking that money and they're reinvesting it to grow their business. Or for the case of a municipality, they're building schools, they're building roads, they're expanding the tax base. And what happens as a bond holder, you've lent your money and then you're getting a rate of return off of that bond. Now, bonds aren't risk-free. They are less risky, or at least historically have been less risky than equities. But of course, they do pay less of a return. But I think bonds are still a good thing. I think they're a stabilizing force. And that's just where I'm at personally. Again, none of this is investing advice for anyone. I'm just sharing what I do. So I do 30% S&P, 30% bond funds. There's all kinds of different types of bond funds. There's long-term bond ETFs like BLV. There's long-term corporate bonds like VCLT, etc. You got to look into that. There's even short-term treasury bonds. There's all kinds of different bond concepts out there, and people can kind of diversify within that as they see fit. So that's 30%, that's 30%, I think we're 60%. Okay. Next thing I want to mention is 10 to 15%. So some of these are ranges, but 10 to 15% cash. Now, cash again cash to me serves a purpose. Now, holding too much cash can be really risky over the long run. And we've especially seen that in recent years because inflation on all types of things has run rampant. So if a person has a ton of money or whatever it might be, let's just say they have $100,000 sitting in cash, every year, if inflation, which it has been for a while, apparently it's cooling, let's hope. If inflation's running 6% a year, well, every year that 100,000 is losing buying power, right? So a person may feel like, oh, it's safe, it's sitting there's 100,000. It's not really that safe. That 100,000 is actually the equivalent a year later of 100,000 minus 6%, which is minus 6,000. It's actually equivalent then to 94,000 in year two. Then if that keeps going on in year three, it's equivalent to, about 88,000. Then it's equivalent to 82,000. That's only 3 years in. 3 years in, that 100,000 does not buy what it used to be. That's why investing is so critical. So 10 to 15% cash. The next sector that I personally like, and it just rounds out my portfolio, is real estate. So I like 15% in real estate. And I like real estate investment trusts. This year they've been pretty flat. That could be a good platform for future years. But I think real estate is another stabilizing force. But I like real estate investment trusts. I like things like Fundrise, and even holding on to maybe some actual physical real estate. But I think real estate is a nice part of a portfolio in an overall wealth building strategy. So that's 15%. I reserve another 10 to 15% for individual stocks or things that I may find innovative that I want to kind of experiment with. So this could be something like, companies that are doing rockets, or Tesla, or space exploration companies, or I don't know, anything that you might think, NVIDIA, something. Now, a lot of that's also contained in the S&P 500, but it could be any kind of stuff that you just want to play with and you just find intriguing and you think it might have a future. But as you can see, you're only taking 10 or 15%. You're not betting your entire, portfolio on that one hot stock that may rocket or may not. There's a lot of risk there. So that's 10 to 15% there. And then the last thing I'll mention, 5 to 10%, and hopefully this is all adding up to 100, that's the idea, is international exposure of some kind, or emerging markets, right? 5 to 10%. So a lot of times emerging markets can be a little juicier, can juice a portfolio, make it even better with its returns. But again, those do hold a lot more risk. So that's how I'll end it there. That's that's the general construction. It might ebb and flow a little bit each year, but that's the ride the bike. That's the way I can just enjoy life. Let the assets hopefully grow over time. There might be off years, of course, but over the long run, probably going to do just fine. And the thing about it is, you're going to want to use the rule of 72 to give you a sense of when. The rule of 72 is if you take the interest rate that you are receiving off of a portfolio, let's say it's 7%, that means you take 7%, 72 divided by 7, and you get 9. Every 9 years, you'll be doubling the initial capital of that portfolio. So every 9 years, you're going to want to see a doubling of your overall assets. It's a really nice goal, actually. Now, it'd be nice to do it faster, but it's a good goal. So that's it in a nutshell. There's no perfect. That's life. So I just want to mention that. There's no perfect portfolio, and none of us has a crystal ball into the future. You have to make assumptions about, Warren Buffett famously says, don't bet against America. I really strongly believe that. I would not bet against strong U.S. companies no matter what's going on, because I think that there's still a very powerful system here, and I think that the country is very poised to do very well. So that's one thing, and that's why I like the S&P 500. And the last thing I'll mention is a big concept of this is risk management to your particular attitude and demeanor and what sits right with you. Some people are absolutely, much more risk averse. So those people are probably going to want to push a little further into, traditionally into bonds and some cash. But remember, the cash has risk as well with inflation. But if people just don't like the undulating, that's going to be a big problem, because you do need to invest and get your money growing for you. So a lot of it's about risk management. A lot of people will probably, I'd like you to leave comments. Let me know what you think. Maybe this Ride My Bike portfolio is too risk averse. It might be. And for some people, they're going to want to juice up the individual stocks and maybe get some options trades in there. They want to do more exposure to the overall equities market. You know, they might find my 30% like way too conservative. So, but that's generally what we're talking about: 30% S&P 500, 30% bonds, 15% real estate, 10% cash, and then 5-10%, you know, international, you know, exposure, and then 10 to 15% in innovation. And that's generally how I like to do it. So, hey, thanks a lot for watching. Please like and subscribe. See you at the next one. All right, take care, everybody.